So hello everyone, we'll start with the topic of the day, that is liabilities, debtors and creditors. We'll also study about the terms, that is account receivable and accounts payable associated with them. So the first very important term is liabilities. Liability means a legal obligation to pay money to third party. Now, very simple definition we talked about. We will study about the example now. Ram is running the business electronic expertise in electronic products. This is the name of the business, electric expertise. He purchased some goods on credit from Clarion Corporation worth rupees 3 lakhs. Now, on credit means that is Ram did make the payment immediately to Clarion Corporation, but instead he decided to pay it in the near future. So the agreement was signed between Clarion Corporation and Ram, and he decided that he will pay the payment after say 3 months. So it is called on credit. That means Ram purchased goods on credit. So Ram is liable to pay money to Clarion Corporation. Ram has a liability towards Clarion Corporation. Ram owes money to Clarion Corporation, and Ram is supposed to make the payment to Clarion Corporation after 3 months. So this is the liability of Ram. Now if we come to the definition part, we will understand that liability is a legal obligation of an entity arising from the past transactions. Now past transactions here means a transaction which happened in the past for which the payment will be done in the future. Okay, so past transaction means transaction arising from the past events. Now they are payable to third parties. Obviously over here if we see the example, Ram is liable to Clarion Corporation, which is third party. Then settlement of these transactions can be done either in the form of transfer of the assets or use of the assets, or maybe in the form of cash also, provision of services and benefits. Now there are three examples of liabilities and many more examples of liabilities. The very basic ones we are talking about here. We talk about accounts payable, which is discussed in the fourth slide, and accounts payable. This is income taxes payable and interest payable. Now, obviously, any person who is doing the business is supposed to make income tax payment to the government, which is a liability of every company or business, and interest payable. Now, if you purchase any loan, if you just borrowed any loan from some financial institution or banks, then you are supposed to make the payment of interest. You are making the records in the books of accounts. Okay, so you'll understand to that example. Like suppose in the previous example, who was doing the business? Ram. That means here debtor will be the any person or individual who owes money to Ram. Okay, because business over here means any person who is doing the business. Okay, so now let us talk of debtors and account receivable. Now debtors and account receivable has a very beautiful connection with this. How it is, see. Now see, if we just understand the example of debtors, Abdul is running the business in electronic gadgets. He sold goods to Mohan worth rupees 50,000 on 1st January 2015. He is supposed to repay that amount to Abdul till March 2015. That means it is clear to you one thing, that Abdul is the person doing the business. He is the business entity, and he is representing the business entity. In books of Abdul, we are maintaining the records, and we have to think from Abdul's point of view that what Abdul is doing. Okay, so here Abdul is selling the goods to Mohan worth rupees 50,000 on credit, because payment was not done immediately. So that means the payment will be done in the future. That means Abdul sold goods on credit to Mohan. You can conclude on this part. Okay, that means Abdul sold goods to Mohan worth 50,000. So Mohan is considered the debtor to Abdul, because since we are thinking from Abdul's point of view, Abdul is the business person, Abdul is a business entity. So we will think who is the debtor to Abdul? Mohan. Though Mohan may be maintaining his books of accounts, but we are not bothered about it. We will think from Abdul's point of view. Okay, it will be recorded in the books of Abdul by the name account receivable worth 50,000. The recording will take place in the books of Abdul, because Abdul is a person doing the business and we're maintaining the books from Abdul's point of view. And one most important thing is that whenever you maintain any person book, suppose you're maintaining books of Abdul, you should never write Abdul name in his own books. This is very, very important in accounting transactions. So never write the name of Abdul in his own books. You always write the name account receivable, and in the bracket you can write Mohan, who is the debtor to Abdul. So debtor is a person who owes money to business. So Mohan owes money to Abdul. So Mohan is the debtor to Abdul. Now we come to the term creditor. Now again, it is a very interesting concept. Creditor is a person or entity to whom business owes money. That means when business sell the goods on credit to third party. Okay. when business purchase the goods on credit from third party, it is called that business owes money to third party. They are considered as a liabilities of the company because here business are purchasing the goods on credit from some third party due to which they owe money to third party. Whenever the word creditor is associated, accounts payable comes into the picture. Now let us understand the example. Shyam is running the business in manufacturing of aluminium products. He purchased some raw materials on credit from Sharma and Sons worth rupees 1,20,000. Now here who is doing the business? Shyam is doing the business. We have to think from Shyam's point of view, and also we will maintain the books accounting records in the books of Shyam. So here what Shyam is doing, he is purchasing the goods on credit. That means he is liable to pay worth rupees 1,20,000 to Sharma and Sons. That means it is a liability of Shyam towards Sharma and Sons. So Sharma and Sons will be considered the creditor to Shyam. Now since we are maintaining the books of Shyam, so we'll never write the Shyam name in his own books. We will write over here accounts payable along with in the bracket we will write about this Sharma and Sons. Okay, so we will write accounts payable in the bracket Sharma and Sons worth rupees 1,20,000. So it is a liability of Shyam. That means in the books of Shyam, the liability will be shown by the name accounts payable. This much amount Shyam is liable to pay to Sharma and Sons. Okay, so this is the meaning of creditor. That means creditor through whom, that creditor is a person or an entity or institution or a company to whom business owes money, to whom Shyam owes money. So here creditor is Sharma and Sons because business is liable to pay money to Sharma and Sons. Now let us understand the difference between accounts payable and accounts receivable. Accounts payable means they are the money owed, and account receivable means they are the money to be received. Now when I say they are the money owed, obviously they are shown in the liability side of the balance sheet because it is a liability of the company. That means they are liable to pay money to third party. When we say account receivable, it is considered as the asset side of the business because account receivable means the amount will be received in some near future. The cash may be received in the near future. Okay, and that cash is considered on the current asset side because we discussed in the previous slides about the previous lessons that current asset is something which gives you benefit for less than a year, and obviously the current assets are easily convertible into cash. And account receivable means they can be easily converted into cash, so they will come in the current asset side of the balance sheet. Now for your further clarity, taken over here the balance sheet. Now if you can see, suppose you are maintaining the books of Shyam over here. So in the books of Shyam, you find out accounts payable. That means accounts payable, that is how much, suppose $8,000. Now it is $8,000 will be considered as the amount which is to be paid by Shyam to some third party. Okay, and if we see in the account, another simple balance sheet, we see in the asset side account receivable. That means suppose it is the business of Abdul. Okay, now Abdul is maintaining the balance sheet and he found that he has account receivable in his balance sheet. It means this much amount he will be receiving from some debtor or some person in the near future. The $6,200 is the asset of Abdul business. Okay, so this is account receivable. It is shown in the current asset side of the balance sheet. So with this, I think the concept is much clear that in the liability side we show the accounts payable and in the asset side we show the account receivable. This is a very conceptual learning of account receivable and accounts payable and debtors and creditors. They have a very interesting connection with each other. So thank you anyone. Thank you.